Hello and thanks for joining us at interest.co.nz. I'm Janae Tibshirani and today I'm joined by the Reserve Bank's Deputy Governor, Geoff Bascand. Thanks for your time, Geoff.
Good morning.
The Reserve Bank has, since the start of the year, employed a number of tools to decrease interest rates in an attempt to encourage more spending and investment to boost inflation and employment in line with its mandate. Is making it cheaper for people to borrow money, particularly at a time businesses don't want to borrow. Is that the right tool to be using to address the current problem that we have?
Well, we think it is really important for us to continue to play our part. There are other things that the government's doing, of course, fiscal policy as well, and that's really important in supporting the economy and its recovery. But our job is to do what we can to achieve our inflation and employment objectives, and we have blunt tools effectively. Ultimately, we have the main way we do is lower the cost of borrowing in the economy, and that flows through lots of different channels. I mean, it flows through into corporate bond markets, so corporates can borrow through the capital markets, raise debt instruments. Ultimately, it flows into keeping the exchange rate lower than it might otherwise be, and it flows directly into retail rates as well. So it's working in different ways, but yeah, hopefully that also builds confidence, and people believe that we're going to achieve our targets, because that's another important mechanism, is that they actually have confidence that inflation is going to come up, and that helps to, in a technical sense, lower real interest rates, but also build inflation, wage setting, and other behaviours, all about a more confident economy in the future.
Okay, but I mean, a lot has been done, and a lot of confidence presumably is there, given the size of the stimulus. We've got the $100 billion quantitative easing program. Now an extra $28 billion will be created and pumped through the banking system. So that's $128 billion, which is more than a third the size of our annual GDP. That's a very large bundle. I mean, how much more confidence does the Reserve Bank need to give people? I mean, has it not done enough?
Well, we will have to judge that when we come back to our next decision in February. Excuse me. But when the committee was meeting this time and assessing where we were, we absolutely acknowledge that the economy is proving more resilient than we thought it would. It's recovering somewhat better than we expected, but it still had a really big shock. And so when we discussed it, we could still see a low growth path, if you like, still unemployment and some business failures coming, and our assessment was that some more stimulus would still be helpful at this time, and so that's what we've judged. Now we always look at the data and read how things are developing, and I think it'd be a great outcome for New Zealand if we don't have to do more. I mean, that would be good. We'll assess that in February, but we weigh up what's needed versus how we think it's playing out, and
okay.
We'll go through that again.
You've decided with the funding for lending program, the bank's making $28 billion available for banks to borrow at a low rate, for them to then on lend at a low rate as well. And you've decided to not put any conditions on that lending because you don't want to stop banks taking it up, because then it might not have the intended effect. But is that an admission that you realise this will go straight into the property market? Because if you put a condition on it for them to lend it to businesses, they wouldn't, because businesses don't want to borrow. So so can we just assume that 28 is going straight into property?
Well, the way the scheme works is that we think it will lower overall funding costs for banks and other financial institutions. So instead of having to compete for term deposits or for wholesale market funding overseas, as much as they would otherwise, they can now be more confident they've got low cost funding from the central bank. So their cost of funds comes down. It means they'll lower, in due course, all their interest rates. And we really want to see that. Business and household lending rates, retail rates will come down. So where they put the credit will be the bank's allocation decisions, for sure. But they have a number of things to take account. If they do household lending, they've still got to be confident that that's going to be repaid, and that's good quality lending, and we're obviously sending them a message about that. Don't do high risk loans. But yeah, we think in the end this will filter through to the economy the most effective way by doing this. But also say we don't actually have any mandate to direct lending to any particular sector. If you want to direct lending, that's really a government policy decision or an initiative. It's not a central bank one. We have overall support for the economy.
Sure. Okay. Geoff, why has the Reserve Bank not included building societies and credit unions in that funding for lending program?
Well, the funding for lending, for a start, is almost in its name. Is what we do is we fund institutions who can borrow from us, and we have rules and conditions that we need that lending to be backed by some collateral that we receive. So they've got to be able to provide that to us, and it's effectively a set of institutions that have got that collateral that qualify for that. But at the same time, we think all financial institutions will benefit, because deposit rates will come down across the market and across for everybody. So that's the main way this scheme will work. It's not actually direct borrowing. As we indicated yesterday, we actually think it'll be quite slow to take up the direct borrowing. It's more that they don't have to compete so much for other funds. And so indirect effect is rates will come down for everybody, and building societies, credit unions, finance companies will benefit from that as well.
Sure. Okay. Just want to talk about the timing of some of the Reserve Bank's announcements yesterday, which is on Wednesday. The monetary policy statement was planned for release at 2 in the afternoon, but then in the morning, the Reserve Bank announced that it would consider reimposing LVR restrictions in March next year, as opposed to in May. Why did you decide to make that announcement on the same day as the monetary policy statement, rather than waiting 2 weeks until the financial stability report? And that, and LVRs kind of fit in that financial stability side of things.
Well, we put out a number of financial stability, as you say, regulatory announcements in that one announcement at 8:30 about the capital regime and dividends, as well as the LVRs. And what we wanted to do was to show that the central bank, we were cognizant of how these things fitted together, and one hand side of the bank was talking to the other side, if you like, and that's important and clear. And we knew we'd get questions in the monetary policy context. Well, what are you going to do about the risks of any high risk lending or capital provisions? And we thought the best way was just to communicate it fully on the one day. So I think that's the right decision, and so we put that all out before the market opened because of the implications for financial institutions of the dividend and capital rules. We put those out before market opening yesterday.
Okay. Was there all a concern that the house price inflation, and I appreciate that that's not part of the Reserve Bank's mandate, but the low interest rates have contributed to house prices increasing, and that's garnered a lot of publicity for obvious reasons. Is the Reserve Bank concerned that focus is perhaps undermining the bank's sort of social and political license to operate its monetary policy?
The concern we have is only about high risk lending. I mean, we don't have a mandate, and we can't control the housing market. I mean, the housing market is a consequence of all sorts of supply and demand factors, the ability to build houses, get land, and so forth, and population growth, and interest rates play a part in supporting that, and in a way we benefit. We need the housing market to provide confidence to households to spend, but we can't control house prices. So what we don't want is high risk housing lending, and that's what LVR's limit is saying to banks: you can still lend to the housing sector, but just don't lend in this place where if things go really belly up, you would be in an uncomfortable position.
But just in terms of the timing of that announcement, being on the same day, and as you said, you know, you wanted to show people that all those components work together. But, you know, is there a concern that people will look at what you're doing with monetary policy and be critical of it or not entirely trust it because of what's happening to the housing market, which is why you then went out yesterday and said, look, yeah, we're adding fuel to the fire with monetary policy, but we're actually also kind of getting out the hose and putting some water on it as well with the LVRs. So don't panic, everyone. Was there a bit of that?
No, our timing is about thinking if we were going to potentially introduce them from March, we had to get out the announcement early enough so that we could release a consultation document before Christmas, get banks and public submissions, and so we were working back from that. And as I say, I mean, there's a general interest in communicating the full picture, but it was also that we don't. The later we left the communication, the harder it would have been to meet a 1 March date, and we would have been potentially surprising people very late in the year. So with what we were doing, so we wanted to give people time.
Okay. Some commentators have raised concerns that by signalling that those LVRs might come back on after this summer real estate season, that'll sort of prompt investors to rush out and get in before they come back on. What would your response be to that idea?
Well, I think the short answer to the banks is to understand the spirit of what we're doing, and when we took them off, we indicated we didn't expect or want banks to go into high risk lending. We took them off to avoid them being a problem for the economy at that time, and you know, not to interfere with the mortgage deferral scheme, but we weren't encouraging higher risk lending. So I think banks should know that they shouldn't be pumping up their pipeline of activity with loans of that sort. And we do know, I mean, housing markets do actually slow down a little bit over Christmas, but for natural reasons. But yeah, there's always some risk that people try and get in beforehand. I'd say the banks have got that in their own control, and they should be managing those risks.
Okay. Did Grant Robertson, when he met with the Reserve Bank, he made a point to the media to tell us that he was meeting the Reserve Bank, which is an interesting signal, I think, that he's trying to tell people, look, I am involved, I am proactive. Did he at all put any sort of subtle pressure on the Reserve Bank to reimpose those LVRs a bit earlier than otherwise perhaps planned?
Not that I'm aware of. He met with the governor, and I think the governor has indicated that they had a general discussion about the relationship between the bank and the minister. And so, no, I'm not aware of anything.
Okay. With the LVRs, is the bank looking at just reimposing those on investor lending, or what are your thoughts on that?
No, our intention is to consult on imposing reinstating the restrictions that we had in place in April before we removed them. So they are restrictions that were specified as you needed, first home buyers, owner occupiers needed to have 20% deposit, but banks could let 20% of new lending through above that limit. And investors had to have a 30% deposit, but only 5% of their lending to investors could be above that limit. So same conditions as what we're planning to consult upon, but obviously we look for feedback and in the submission process. I mean, the nature of those is that they're more binding on investors than they are on owner occupiers or first home buyers. The speed limit, as I say, that 20% limit, banks tended to use that mostly for first home buyers previously, and we would expect that they'd continue to do that. It's a restriction on high LVR lending for anybody, but it's in that sense we're trying to stop all high risk lending, but it's probably a tighter restriction on investors than it is on owner occupiers. Why
wouldn't you leave the owner occupiers out of it and just let banks make those calls? Because as you say, they probably already require largely 20% deposits anyway. but why put that restriction on, a segment of the population, especially first home buyers who are really battling to get into the market?
Well, I mean, it's the same reason as we put the restrictions on at all, which is we just don't want to see rapid growth in high risk lending. And when we had no restrictions back in 2013, we were seeing a lot of lending going at 85, 90% LVRs. And the problem with that is if the housing market does take a downturn, and we certainly expected that earlier under the pandemic, then people are exposed, and they suffer losses, and then the banks suffer losses. So look, that's the general thing, is that we're trying to keep those credit standards up for everybody. We see a little bit more risk with investors than we do with owner occupiers, which is why we have tighter rules for them.
Sure. Okay. No, fair point. Geoff, I know this covering lots of ground here. Just want to talk about the Reserve Bank's mandate. Arthur Grimes, former chairman of the Reserve Bank and chief economist and sort of esteemed academic, has suggested the Reserve Bank in its monetary policy mandate be made to consider asset price inflation as well as CPI inflation and employment. What are your thoughts on that idea?
Well, I think it's been suggested in the past, and it's a difficult idea to work out exactly how we would control asset prices. So I think there are times to think about these things, and periodically we do need to review mandates, and there's a process for that. But there's no easy win here. What tools would we use? How would we do it? If we raise interest rates to a control an asset price, we potentially harm the economy, the borrowing that's going on, and then the need to support employment. So I think that the world is still trying to work out how we deal with what have been secularly low interest rates around the world. They've come down a long time, in a steady path, if you like, for 30 years, and inevitably that does mean asset prices have been boosted because discount rates are lower. But it's a very hard question to think about whether we could, on a regular basis, control multiple things like asset prices and inflation. So I would say it's a research question for the future, would be my short answer.
Okay. Geoff Bascand, thank you for your time. And I'm Janae Tipsharani from interest.co.nz.